I now hand the conference over to Mr. Dhruv Jain from Ambit Capital. Thank you, and over to you, sir.
Thanks. Welcome to the Q2FY21 earnings call of Dixon Technologies. From the management, today we have with us Mr. Atul Lal, the Managing Director of the company, and Mr. Saurabh Gupta, the Chief Financial Officer. Over to you, sir, for your opening comments. Thanks.
Thank you so much. Good afternoon, ladies and gentlemen. This is Atul Lal. We also have on the call today my colleague Saurabh Gupta, CFO.
Hi. Hello, everybody.
I hope that you and your families are safe and healthy. So I'll just share with you an insight into Dixon's numbers of Q2 2021. Our consolidated revenues for the quarter ended September 30, 2020 was rupees 1639 crores against 1405 crores in the same period last year. That's a resilient growth of 17%. Consolidated EBITDA for the quarter ended September 30, 2020 was 89.6 crores against 65.9 crores in the same period last year. That's a growth of 36%. EBITDA margins have expanded from 4.7% to 5.5% year on year. This is mainly on account of operating leverage, improved sales mix, value engineering, productivity improvement, and other cost efficiencies. Interestingly, we have seen margin expansion across all our key product categories. Consolidated PBT for the quarter ended September 30, 2020 was rupees 71.8 crores against 48.3 crores in the same period last year. That's a growth of 49%. This is mainly due to the reduction in our finance cost. Healthy growth momentum was witnessed in all verticals in Q2, and we have an extremely healthy order book across all the verticals. We look forward to regaining faster momentum in the forthcoming quarters and expect revenues and profitability to increase on account of a healthier order book. We are well positioned with robust balance sheet with cash balance of 74 crores and net debt of 17 crores as on 30th September. We have adequate working capital lines to ensure that even if things worsen due to pandemic, we are fully protected and continue to build our business in capability through this difficult and uncertain period. We are generating strong cash flows, have adequate liquidity, and have enough cushion in the balance sheet to raise debt if required to meet the planned capex in the pre-COVID period. We have a strong conviction, as I've been reiterating in all our interactions, that consumer durable and electronic items that will be sold in India are going to be made in India. And Dixon in this space is sitting on a sweet spot. More and more brand owners will outsource more manufacturing. And in Dixon, we have been able to build a scale and a skill set and capability to execute that. Further, the momentum of domestic manufacturing is aided by the government schemes. It is beneficial for the company hugely. Our main focus, as we have maintained right through our journey, is on prudent backward integration and migrating more and more to our own design solutions, which helps in expanding the margins and further enhance the stickiness with our customers. Our capital allocation will always be prudent and very frugal. We are maintaining that we will be generating a return on capital employed of 30% plus and return on equity of 25% plus in the forthcoming quarters and years. Now I'll share with you the performance and the strategy in each of the verticals going forward. In consumer electronics, that's LED televisions mainly, revenues for the quarter under review was 957 crores against 738 crores in the same period last year, which is a strong growth of 30%. And this is in spite of July, we were in the process of recovering only. So we have not hit full July. And there were also certain supply chain issues. Operating profit saw a robust growth of 50% year on year. It was 26.5 crores in Q2 2021 against 17.7 crores in the same period last year. Operating profit margins also expanded from 2.4 to 2.8% year on year on account of scale, higher level of backward integration, the expansion of a PCB capacity, and also there is an improved sales mix, wherein the share of the large screen sizes, that is 43 inches and above, has significantly increased, which is generating better margins. As I had shared in the last call, we've already completed our capacity expansion of 4.4 million TV sets, including backward integration and LCM. And also we have doubled our capacity by installing the second line of SMT for PCB. This capacity is almost 30% of the Indian LED TV market, so we acquired a large scale, and it's a global scale now. In order to meet the strong order book of our anchor customers, Xiaomi, and newly acquired customers like Samsung, Nokia, Hisense, Toshiba, and also in view of the recent notification wherein imports on complete LED televisions has been shifted to prohibited category, to licensed category, we are witnessing a significant traction in additional volumes. So we are further expanding our capacity from 4.4 to 5.5 million in this fiscal. We are confident of executing this expansion plan within Q4 of this fiscal. That will take a capacity to almost 5.5 million sets per annum. Putting LED TVs under restricted category will not only boost domestic manufacturing, but will also deepen level of manufacturing in India and accelerate sourcing of brands of domestically designed solutions for LED TV. So that's the path we are pursuing. We're strengthening our R&D and trying to get a larger share of customers' business through our own design solutions. We are strengthening our R&D, and we've also tied up with some global design houses like Soin Technologies in the US for premium sound solutions. The latest customer addition in our customer portfolio of LED televisions is View, which is a significant domestic player in LED televisions. The production for View is going to start in November. And also we've acquired OnePlus as a customer. For OnePlus, the production will start in Q4 of this fiscal. Coming to lighting, revenues for the quarter witnessed growth of 4%, that is 296 crores in Q2 against 284 crores in the same period last year. Operating profit witnessed a strong growth of 21%. There's 27.7 crores in Q2 against 23 crores in the same period last year. The margins of the lighting business have expanded from 8.1% in Q2 last year to 9.4% in Q2 this year, primarily due to operating leverage, migration to more ODM. So in last quarter, the share of our ODM business was more than 90%. Further value engineering and also automation. All the brands in lighting business today who are our customers are on ODM basis, and practically most of the brands today are our customers. We are India's largest ODM in lighting, and we already have a capacity of almost 250 million bulbs, LED bulbs, which is more than 40% of the Indian requirement. We have also developed solutions for the smart LED bulbs, battens and downlighters, and emergency bulbs and battens for various customers. As shared with you on earlier occasions, we have expanded our capacity of battens from 250K in phase 1 to 1.5 million, and this is a number we'll be executing in our October month, and also 2 million. So this 2 million will start happening per month, hopefully for the month of December. In the case of downlighters also, we've expanded our capacity from 150K per month to 600K per month, and we'll be going to 1.2 million per month by Q1 next fiscal. We feel the kind of volumes and entire range of portfolio, we are now globally competitive and among the top companies in the world as far as volume is concerned. We have the cost competitiveness now to explore the global markets. We've already sent pilot consignments for our anchor customer to US and Indonesia, and we are in discussions with some large chain of stores for exploring the international opportunity. We're also automating a line, and 1/3 of our volumes of LED bulbs will get automated within Q3 of this fiscal, which will give a significant boost to our productivity. Now we are venturing into outdoor lighting, that is primarily street lights and 2x2s. We are confident of launching this product portfolio by Q1 of the next fiscal. On home appliances, revenues for the quarter saw a growth of 4%, that is 139 crores in Q2 versus 145 crores in Q2 of this fiscal versus 139 crores in last fiscal. The operating profit increased by 5% year-on-year, that's 17.3 crores versus 16.4 crores in last year. The EBITDA margin in this vertical is 11.9%. We've had our highest ever sales of 1.14 lakh and 1.17 lakh machines in August and September respectively. So to meet the festive peak period demand, we've added one more line within a very short period of time. We presently have 140 odd models and have the largest portfolio ranging from 6 kgs to 10 kgs across semi-automatic category with an annual capacity of 1.2 million. In Q3, we'll be launching a new 10 kg model and also an electronic panel model for which there is a significant traction. Our expansion plans for fully automatic top-loading FATL washing machine is on track. In our Tirupati campus, a new factory is getting ready. We are fairly confident of our trials in end of Q3 this fiscal. There are approximately 30 variants in fully automatic category to start with, and we'll have an annual capacity of 6 lakhs. We are targeting to start the commercial production in Q4 of this fiscal. We have already closed an agreement with a very large global MNC. In this vertical, we have a roadmap of more and more localization, and we feel fairly confident that in the next 18 to 24 months, the imports will come down to barely 30%. Coming to mobile phones and EMS division. So from this quarter, friends, we will be reporting mobile and EMS divisions. Presently in the EMS division, we are doing set-top boxes and medical equipment. So we'll be combining the results of them together. Revenues for this division for the quarter was 197 crores as against 193 crores of mobile revenues in the same period last year. In the current quarter, the revenues of set-top box business and medical equipment business was rupees 35 crores and 96 lakhs, respectively out of 197 crores. Operating profit witnessed a very strong growth of 294%. It was at 16.2 crores against 4.1 crores in the same period last year. This is mainly on account of our anchor customers, a 2G phone business and also set-top box business. Operating margins have also significantly expanded from 2.1% to 8.2% year-on-year. We today have largest capacity of 2G phones in the country. We are the largest manufacturer, and this is happening for our anchor customer both for domestic and export markets. We are confident that the numbers for Q3 and Q4 will be better than Q2. The 100% subsidiary company in which we do our mobile and EMS business is Padget. We have a very strong order book again from on a smartphone as well as the 2G phones. Recently, we got the approval under government's PLI scheme on mobile phones. The government plans to provide incentives up to 41,000 crores over the next 5 years period. Let's share the contours of the scheme. There's an incentive for incremental sale for
This is the operator. Sorry to interrupt you, sir. The audio is breaking, sir, from your line. Please check.
Okay. The tenure of the sales is from 2020.
Sir, this is it's still breaking, sir. It's not coming clear.
Just feedback, please.
Sorry to interrupt you once again, sir. The audio is not coming clear, sir. So I'll reconnect your line once again, sir. Ladies and gentlemen, we are reconnecting the line for the management. Please stay connected. Ladies and gentlemen, thank you for patiently waiting. The line for the management is reconnected. Thank you, and over to you, sir.
Sorry about this interruption. So I was sharing the contours of the scheme. Domestic companies are incentivized for mobile phones of less than $200. That is 15,000 rupees, which is a special carve-out for domestic companies with a capex investment of 200 crores over 4 years. Eligibility will be subject to thresholds of incremental sale of manufactured goods. Incremental sales of manufactured goods over base year for financial year 21 is 500 crores, financial year 22 is 1,000 crores, financial year 23 is 2,000 crores, 24 is 3,500 crores, and 24 is 3,500 crores, and 25 is 5,000 crores. One positive thing is that the ceiling revenues have been revised upwards in favor of domestic companies. So now the revised ceilings for 21 is 2,000 crores, 22 is 4,000 crores, 23 is 6,000 crores, for financial year 24 is 8,000 crores, and financial year 25 is 10,000 crores. We've already started investing to increase our capacities of a smartphone, and we'll be taking it to 15 to 16 million level annually in next couple of years against 3 million today. We have already taken a factory on lease in Noida, approximately 200,000 square feet. We are fairly confident of starting the new capacity by early Q4, that's January of this fiscal. We are in in deep and final round of discussions with 3 large global brands. This is in addition to our present anchor brands for tie-up for manufacturing for them, both for domestic and global markets. I'm not in a position to share the names as of now. Hopefully, we'll be sharing these names very shortly. We think it is a big opportunity for the company, and we're confident of generating the cumulative revenues of 28 to 30,000 crore revenues over a period of 5 years with a decent EBITDA margin and a very robust ROCE and quick payback on the investment. We're also hopeful that even the first year incentive of incremental sales of 500 crores for August 20 to March 21, we will be able to avail the benefit to some extent. Although it's a challenge to start fresh production barely in 3 to 4 months, but I'm fairly confident that our team will be able to deliver on it. On set-top box side, we have already delivered 5.2 lakh cable and hybrid set-top boxes for Jio, Dish and Cherry Cable, and we have generated revenues of almost 35 crores. We have a strong order book of almost 0.3 million per month from October onwards. On medical electronics also, we dispatched our first set of 40 machines, and now consistently we're delivering to Moldeo, and this will be a decent high margin business for us. Coming to security surveillance systems, there is a 9% degrowth in our share of 50% revenues. So from 43 crore in Q2 of 19-20, the revenues have come down to 40 crores. However, the operating profit witnessed a growth with an expansion in the operating margin from rupees 1.06 crores of 2.4% in Q2 19-20 to 1.17 crore with an operating margin of 2.9% in Q2FY21, mainly due to the reduction in the fixed cost. Now this vertical has also come back to the normal capacity utilization, and we feel that we have decent numbers in Q3 and Q4. Reverse logistics, revenues for the quarter was 3.6 crores with an operating profit of 37 lakhs at 10.2% operating margin. Our both set-top box refurbishment and LED TV panel repair business is doing fairly well, and we have a strong order book. In fact, we are setting up a small center in Tirupati also for this because it is more of a strategic kind of business. So I would like to stop here now, and me and Saurabh are there to answer your questions. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Reminder to the participants, anyone who wishes to ask a question may press star and 1 at this time. The first question is from the line of Aditya Bhartia from Investec. Please go ahead.
Hi, good evening, sir. Thanks for the detailed update. That clarifies a lot of things. My first question is on working capital, which appears to have risen a bit in second quarter. What has contributed to the same?
Hi, Aditya, how are you? There was a bit of a challenge in supply chain. The transit period in the imports and also custom clearance time expanded a bit by almost 12 to 15 days, because of which there has been some pressure on the working capital. But we are extremely confident that it's going to come back to normal. It already has by October end. And this has happened mainly due to our TV television business. We'll come back to normal by Q3 end.
Yeah, Aditya, this is Saurabh. So as Mr. Lal mentioned, it is already partly corrected in October month, and it will significantly get corrected by end of quarter 3, by end of December.
Understood. And from a longer term perspective, so do you see any issue of continuing to import open cell panels, or do you think government would want that to start getting done in India as well?
Sorry, just come again?
So from a slightly longer term perspective, do you see a challenge of continuing to import open cell panels, or would ultimately the government be wanting open cell panels to also start getting manufactured in India?
So I think government intent would always be to create that ecosystem, and if open cell fab can be set up in India. But it's not a simple business. It's a huge capex. So I think one will have to wait and watch. At present, I feel the open cell will be a significant import item in every television as a category.
And so when we say that TVs have been placed under restricted category, there's no restriction on open cell panel per se, or do you think that even that is getting a bit more difficult to import?
No. Open cell is under OGL, and there is no restriction as such.
Understood.
So I don't see any challenge in imports of open cell.
Understood.
From the government perspective, yeah.
And so my next question is on the PLI scheme. So obviously you did highlight quite a few things on the scheme. How should we be really looking at it? Would we be looking to operate at maybe the ceiling limits of the scheme and generate a higher EBITDA margin? Or rather, could the strategy be to deliver revenues higher than the ceiling limit, maybe at a slightly lower margin?
So we are evaluating both. It's a question of slightly longer term perspective. So we have to strike a balance. Possibly we'll be going even beyond the ceiling.
Sure. Understood, sir. Thanks for this.
Thank you, Aditya.
Thank you. The next question is from the line of Ravi Swaminathan from Spark Capital. Please go ahead.
Hi, sir. Good afternoon. Congrats on a good set of numbers. My first question is with respect to the margins in the mobile phones, sir. So basically, mobile phones and EMS margins are 8.2. How much of it is for mobiles alone, and what is the kind of margin profile of the other two products which are there in this? That is the medical devices and other products.
Yeah, so as Mr. Lal mentioned, that the revenue generation from set-top boxes is around 35 odd crores. The margin profile in that particular business is somewhere around 3.2%. And set-top box, the medical electronic business has just started. So I think so it will be prudent for us to give you the margin profile only next quarter. So it will be slightly higher. So broadly, you can assume a margin of around 20-22% as far as medical electronic is concerned. But we are a very small, just 96 lakhs of revenues. But yeah, the quarter 3, the revenue should be higher. And of course, the profitability from that vertical should also be higher.
Okay. So now what I'm trying to ascertain is, has the margins in the mobile business also expanded? Is what I'm trying to.
Yeah. So Ravi, basically it expanded on account of the anchor customer that we acquired in November last year, for which we are manufacturing the 2G phones. So it was not there in the similar period last year, in the comparison period. So that is basically, there the margin profile is higher. So these 3 would be the reasons why our overall margins have actually gone up.
Okay. And my follow-up question is on the PLI scheme. So basically, you had mentioned 3 large customers with whom we are talking about. Would they be, put together, would they alone individually cross the 10,000 crore kind of revenue target that is being set for FY25? And if that is so, blended, what kind of margins we can make on a sustained basis over the next 3 years average, 3-4 years?
So one, we are fairly confident of achieving the revenue targets that we just shared and you also just mentioned.
Mm-hmm.
We feel that the operating margin should be somewhere in the level of around 3%. this business.
Got it, sir. And with respect to the electronic TV, the new customers, VU, OnePlus, etc., if you can share what kind of potential volumes can be there from them, it will be great.
So the indicative volumes that we are expecting from the new customers, that's the names that you mentioned, should be somewhere between 0.8 to 0.9 million TVs per annum.
Thank you. Mr. Swaminathan, may we request that you return to the question queue for follow-up questions. Ladies and gentlemen, in order to ensure that the management is able to address questions from all participants in the conference, please limit your questions to 2 per participant. Should you have a follow-up question, we would request you to rejoin the question queue. The next question is from the line of Bhumika Nair from IDFC. Please go ahead.
Yeah, good evening, sir, and hearty congratulations for a very good set of numbers. So my first question is on the TV segment, which has seen a very strong growth led by addition of new clients. As we are adding, as you said, VU, OnePlus, and some others, how quickly do you expect the volumes to kind of scale up? What is the current level of utilization, which is what is making you confident to kind of expand capacity to 5.5 million from the current 4.2 million? Sorry, 4.4.
So Bhumika, we did almost 300K, in fact 318K televisions in the month of September.
Mm-hmm.
In the month of October, we're going to close at 360. And the order book looks healthy. And then from the month of January, we're adding some more customers. And also, please appreciate that there is a peak always in TV business around the festive period. So we need that buffer. That's the reason we are expanding the capacity. Because the forecast being given to us by our existing anchor customers and also the new acquisitions are very healthy.
So what I'm trying to just understand is that, what proportion of this would be led by the import restriction ban in the current quarter, or is that still yet to play out and this is largely led by strong festive demand and, client addition that we saw earlier during the year?
So my sense of things is that the import restrictions have still to play out. So usually the dip that we have post Diwali, we will not see that this time. It's going to be compensated by additional traction from the customers.
Got it. So my second question is on the home appliances and the washing machine space. Again, they're a fairly healthy performance. How are we seeing in terms of the fully automatic washing machines to kind of come in and contribute? By when is that expected? And any client additions out here? We spoke about new model additions in 10 kgs, etc. But are there any client additions out here that we are targeting?
So as I shared, Bhumika, that we are fairly confident of starting a commercial production of fully automatic top loading in Q4 of this fiscal. The facility is getting ready. We already have an anchor agreement signed with a large global customer. We are going to be rolling out our samples by November end, early December of this fiscal. And we are already in discussions with all the existing brands who are our customers in semi-automatic category. We are confident that we'll be able to get significant breakthroughs because the solutions that have emerged are extremely good. So we are fairly confident and that the revenues are going to start from Q4. But for the business to acquire the actual mass will take time. It will take a couple of quarters.
And you think these would be at similar margins as our semi-automatic washing machines? Or do you think it will take time to scale up?
I think so. Finally, yes.
Okay. Great. So wish you all the best. I'll come back in the queue. Thank you.
Omega.
Thank you. The next question is from the line of Sonali Salgaonkar from Jefferies. Please go ahead.
So thank you for the opportunity and congratulations on a great set of numbers. So my first question is again on the PLI scheme. I know you mentioned that you are in the final round of discussion with 3 large global brands. But, over and above these 3 brands and our anchor customers, potentially which other clients could we, target in terms of attaining our revenue target, say, that you said of about 280 billion to 300 billion revenues over the next 5 years? And also, if you could throw some light on the value addition aspect of that.
Thanks, Sonali. So, one, we feel that these 3 customers' agreements in itself are more than sufficient for meeting the ceiling numbers under the PLI. In fact, what I can sense, there is a problem of plenty there. However, in every vertical, if you see Dixon endeavor is to start first level of assembly, deepen the manufacturer through motherboard, if possible, go in and use our skill set in polymer processing, and make an attempt for our own design solutions. So please be rest assured that in mobile also, we have already initiated this journey. It's going to take time, but it's going to happen. So that's the path we're going to pursue. We aspire to emerge as an ODM player in the smartphones as well. And also I would like to share that the infrastructure being set up is also having the capability of doing 5G phones.
Understand.
So that's the path we will be pursuing, Sonali.
Sure, sir. And also you spoke about the capacity in the smartphone being enhanced to about 15 to 16 million. So currently we have 40 million capacity in mobile phones. So just wanted to understand, is the capacity for feature and smartphone fungible, or else what is the breakup of this 40 million?
So the capacity is fungible, but in mobile, or for that matter in any electronics manufacturing, to put it in very layman kind of terms, it's ultimately the component count on the motherboard and the test setup. So usually you can take a ratio of 1:3. On a line on which you do one phone, smartphone, a 4G phone, you can do 3 2G phones.
Understand, sir.
That's the kind of a number.
Sure. Sir, my second question is...
So infrastructure is fungible not only for smartphones and mobile phones. The line on which we are doing our smartphones, we're also doing a set-top box on the same line. We're also doing our medical electronics on the same line. So it's fungible right through.
Got it, sir. So my second question is on the customer concentration and utilization. So, sir, we understand that probably you don't share numbers of how much our top 5 clients are contributing to in-per segment right now. But any broader idea of how concentrated every segment is in terms of our anchor customers? And currently, on an average, what is the capacity utilization that we are working at?
So, Sonali, I'll share with you the numbers. Our topmost customer contributes around 30-32% of our revenue, followed by the second one, which is around 17%. However, when you look at the profitability profile, the biggest customer contributes around 14.7% of our operating profit. Now, we're very conscious of this, and if you look at our numbers in 17-18, when we were listed, almost 85% of our profits were coming only from 2 anchor customers. So in spite of the growth, this ratio has rationalized. It has become much, much better. And let me assure you that the growth and diversification that we are having is going to have a much larger sense of balance. On the capacity utilization, I'll just share with you the numbers. So in lighting overall in Q2, we've used 81% of our capacity. In LED television, it's 78%. In home appliances, is 83%. In mobile phones, on the 2G side, we've used almost 68%. And on the smartphone side, we've used a smaller one of 35%. In security systems, because Q2 was under pressure, the capacity utilization was around 36-37%. However, the capacity which was not utilized for phones and set-top box and CCTV was used for set-top boxes. So that's the status. So overall, you can say that the capacity utilization is between 75 to 80%.
Understand, sir. And my last question is, our ODM share currently is at about 35%. Any vision as to where we want to get it, say, over the next 5 years?
So the path is like that. But as a percentage, because at present the ODM share is primarily from home appliances, which is 100%, and from lighting, which is around 90%. From consumer electronics, it still is very small, it's just 3%. And in other verticals of ours, primarily OEM business, which is on prescriptive mode. Now, the humongous growth is going to happen on the mobile side, on the EMS side. So I don't see as a percentage ODM contribution will increase. But in absolute numbers, the ODM contribution will significantly increase. However, as I shared, that if we are able to get breakthroughs, because that's the path we are pursuing in LED television already, and we're going to trigger that on the smartphones also, if we are able to crack it, and hopefully we have that tenacity, that in a couple of years, a significant portion on an overall basis would come from ODM. What percentage? I don't know.
Sure. Thank you, sir. That's it from my side.
Thank you. The next question is from the line of Renu Baid from IIFL. Please go ahead.
Yeah. Hi, good evening, sir, and congratulations for the strong performance this quarter. My first question is to understand a bit more, since you've highlighted that you would want to aspire to emerge as the ODM solution provider in smartphone segment. If you look globally, this trend has picked up in the sub $150 market, but essentially the companies who are concentrated in this segment are the ones who also have strong capabilities on the semiconductor and the chip side. Today, even if you're aspiring today, what is the base homework that you're starting in this segment to scale up the R&D capabilities? And also related to the same question is, across new segments that we are entering, whether it is refs and mobile phones, they are far more complex products in the current profile. So what is the kind of beef up that we're doing on the R&D side of the business to improve ODM solutions as well as continue upgradation of the existing portfolio?
So Renu, it's a journey. Now, I think the team has done fairly well in the verticals of lighting and appliances as of now. And in appliances also, launch of fully automatic top loading is going to be a significant milestone for us. Now, same is the case in LED television. So we are ready with the solution, and we are ready with the solutions on the smart side also, and also on the Android solution. So the team has been able to execute that. When we come to smartphones, it's a much more complex journey. So it's going to happen to start with through partnership rules. First, the focus is going to be on sourcing and supply chain, and closely working with the chipset people like Qualcomm and MediaTek. And those skill sets have to be built. But we're going to start that journey. On the refrigerator side, we have a leadership team who has executed large DC projects. We have confidence. We've inducted some talent already from the industry for leading this project. So once we take the final call of launching it, because we're looking at some other inorganic opportunities, let's see how it pans out. Otherwise, we're going ahead on our own. We already have a technology partner in place. We have selected the product portfolio. Yeah, it's going to be a slightly longer gestation product, but it's going to happen. Please be rest assured.
Sure. And have we earmarked or have we targeted X proportion of spending on R&D in the next 3 to 4 years and targeted team size, or it would be decided in the due course of time?
So it's going to evolve and it's going to be decided in due course of time.
Sure. So second question is to understand a bit more on the margin side, specifically for the LED lighting segment as well as for washing machines. Should we say most of the margins could also be driven by the strong volume and a bit of benign cost structures or inventories which were carried from the previous quarter? And cost headwinds could moderate a bit of the margin profile going forward? Or what would be your sense that given the mix of new customers coming in these categories and portfolio, 9% margins in lighting and about 11.5%, 12% margins in washing machines seems to be more sustainable trend?
So, both in lighting and washing machine, the margins are a derivative of various elements. One is value engineering, which is an extremely important element. Second is continuous automation and reducing the manufacturing costs. So we already embarked on this journey in lighting. And third is the commodity prices and the currency. So how it balances out, one has to wait and watch. But I feel that in lighting, the margins are going to be hovering between 8 to 9.5%. And in the case of washing machines, it will be somewhere between 10, 10.5 to 12%, somewhere like that. So I can't predict the exact number, but that's the range in which I feel that the operating margins are going to be going to be there.
Sure. And my just last question would be a bit of clarification again on the set-top box part of the portfolio. Given that now we have strong order book scaling up from 3Q, we had set aside an aggressive target of 1,000 crore plus of revenue in the next financial year. So are those targets intact both with respect to orders from customers, or are we seeing a new addition of portfolio in that business?
Yeah, so we are fairly confident that next fiscal that will be the written number. The order book looks healthy. So I think they're fairly doable numbers.
Yeah, so Renu, just to add, if you look at our quarter two numbers, we mentioned in our earlier remarks that we did 5.2 lakh units, and we also mentioned that we have a order book now of almost 3 lakh units a month. The revenues in H2 will be significantly higher than what we have done in Q2. So even within this year only, we will start generating in H2 only around somewhere around 400-450 crore kind of revenues in set-top boxes. So next year, the revenues of 1,000 crore which we had guided for looks absolutely intact.
Wow. So which means broadly for the current financial year, set-top boxes could do approximately 500 crores or close to 500 crores kind of revenue.
Yeah, that's right.
And overall, I think with volumes, margins in STP business will also improve, or they should be broadly in similar 3.5% range?
They will be in the range of 3 to 3.2%.
Perfect. Sure. Thank you so much.
Yeah, ROC profile will be very good because we are the incremental investment will be very minimal.
Right, we're using the existing capacities there. Got it. Sure. Thank you and all the best.
Thank you. The next question is from the line of Dhruv Jain from Ambit Capital. Please go ahead.
Hi, sir. Sir, one question on the AC PCB revenues that you have mentioned and disclosed, right? While it is small at around 18 crores in this quarter, but if you could just throw some light on how it's been in the last couple of quarters and what customers that we're doing, and if we can add some more customers on that front.
So this particular vertical, Stan, is we're doing for Daikin, and we have a tie-up with a Japanese solution provider for inverter controller PCBA, Rexon. Rexon Japan is a global partner of Daikin, and we're into this business for last almost 3 years. And all the inverter controller PCBA for Daikin are done at Dixon. Last 2 quarters in this particular vertical have been under pressure because of lockdown, and also the AC market was impacted. Yeah, whether we are looking at expansion of this particular business, we are, and we're talking to some other brands also for a breakthrough in this. Let's see.
So, what was the FY20 revenue, sir, yours then?
Dhruv, so basically, in a normal situation, we were doing revenues of somewhere around 35-40 crores a quarter. So it should be somewhere around 135-140, plus minus something. So I don't remember the exact number, yeah. But 35 crores was the quarterly run rate.
Okay, and sir, margins around in this vertical?
So margin is also similar, somewhere around 3.5-4%.
Okay. And sir, you spoke about a tie-up that you are doing with respect to creating your own ODM solutions in TV. And sir, so if you could just talk a little bit about that, and when do you expect to sort of get a breakthrough there in terms of getting your own design?
So on the analog side, our solutions are already going. Even to the brands like Panasonic or Senio, to domestic brands like Lloyd, or to Intex, or to Reliance, or Reconnect, they're all Dixon's ODM solutions. We are ready with the smart solutions also. In that, one is the open software, and the other one is the Android solution. The market is shifting more and more towards Android solutions. We are working on a possible relationship with Google and getting an Android license, but we are still working upon it. However, as far as the solution is concerned, we are ready with it. We're ready with both the electronics and the mechanicals on the Android side also. So that's the status.
Okay, thank you, sir.
Thank you. The next question is from the line of Ankur from HDFC Life Insurance. Please go ahead.
Yeah, hi sir, good evening. A couple of questions. One, could you please share the volume numbers during the quarter across segments, the TVs, washing machines, lighting, and cell phones?
Yeah, sure, Ankur. Just give me a minute.
Sure, thanks.
So TV we did around 8.5 lakh units.
Okay.
Yeah, as against 7.5 lakh in the same period last year. So broadly there is a 14% kind of a volume growth.
Okay.
Overall, in terms of lighting products, which includes LED bulbs and other products like back and town lighters, we did around 571 lakh units as against 508 lakh units. Mainly there has been a significant increase in LED bulbs there.
Okay.
In terms of mobile phones, which includes both the 2G and the smartphones, and for our anchor customer as well, we did around 96 lakh phones, and as again 16 lakhs last year. So mainly the growth has been mainly on account of the growth in our anchor customer of 2G phones. Then in the case of CCTV and DVR, CCTV we did around 6.6 lakh units as against 6 lakhs same period last year, and DVR we did 2.1 lakh, which is almost similar as last year as well. And set-top boxes I mentioned that we did 5.2 lakhs, and medical, we did a first dispatch of 40 odd units.
And some washing machines? I think that's one.
Sorry, I missed washing machine. Washing machine we did 3.1 lakhs.
Okay.
Against 2.8
lakhs.
Perfect. I have the previous year number. Great. Thank you so much. So secondly, just on the TV margins and, what we've been hearing is that open cell prices have actually jumped over the past quarter. Most of it is sourced from China and I'm guessing also Thailand. So how has that worked for you? Have those price increases been completely passed on to your customers? Because I normally thought that there's a certain lag, right, before those prices get passed on.
Ankur, our LED TV business is an OEM business, and all the cost variations are passed on to the customer. In this business, there is no lag.
Okay.
So you are absolutely right. The prices of open cell globally have really shot up significantly. However, in our case, all the costs are passed on to the customer.
Perfect. Okay. So they're being passed on. Okay. And so thirdly, just on this jump in debtors and payables that we see this quarter. So while I understand that maybe because of the restrictions on imports, you may have delayed payments to your vendors. But I'm just trying to figure out what led to this big jump in debtors as well, at about 1,100 odd crores. And where do you see this and how do you see this normalizing? Yeah.
So basically, if you look at the TV sales, we did almost 950 crore of revenues. So mainly the receivables have increased, and even if you break down the entire quarter two performance, our September month performance was better than August, and similarly August was significantly better than July. So if you look at the numbers, it's mainly increased on account of TV business, where our debtors have increased and correspondingly the creditors have also increased. So we don't deploy money in the working capital since it is a prescriptive business. So both debtors and creditors have increased.
Okay, and as production normalizes, as you said, you would see these numbers coming back to the previous numbers, previous historical numbers, right? So you wouldn't expect them to remain as elevated going into Q3 and Q4.
So if you look at the debtor days, actually, you should more instead of actual number of debtors, if you look at the debtor days, so our debtor days was around 58 days, and it was a similar level at around June of 57 days. What good in the whole cash conversion cycle, inventory days will actually come down to 28 days as against 45 days, and creditor days is 86 days as against 93 days in the month of June.
Okay. All right. Okay, great. Thank you so much. Appreciate it.
Thank you. The next question is from the line of Akshay Bhor from Premji Invest. Please go ahead.
Hi team, good set of numbers and thank you for the opportunity. My first question is on the PLI scheme and given there'll be government receivables involved in there, what kind of contract structure are you working with with the customers, and what kind of delay in receiving those payments is anticipated by the customer? Any clarity there?
So the contracts are in the process of getting finalized and structured. However, please be rest assured there are adequate preventive mechanisms in the contract that the customer will be reimbursed on the PLI side only once we receive the incentive from the government.
Understood. And what kind of delay do you anticipate in receiving those? Is there a within the PLI scheme? Is there a mention of what kind of delays are anticipated?
Well, as per the contour of the scheme, what it says is that you have to meet the eligibility criteria, which is two elements. One, you have to have a capex confirmed of 50 crores before filing your application. Second, you have to meet the threshold plus the incremental number of your baseline figure. Once you have achieved that threshold with adequate evidences, the application has to be filed with the project agency, and they're going to verify the data, and the incentive will be credited to your account. That's what the mechanism says. and the application has to be filed on a quarterly basis.
Yep.
So, I'm not in a position to say that how it actually works, but the laid down guidelines in the scheme are as I just shared with you.
Understood. Just a clarification on the lighting side, the volume growth is slightly tepid in the quarter, even on the appliances side as well. Just wanted to understand, this is nothing to do with any loss of customer having issues. This is just the industry growth being muted.
Sorry?
Akshay, I don't know what numbers. So if you look at the home appliances numbers, we did 3.1 lakh washing machines, almost equivalent to what capacity we have, and as compared to 2.8 lakh washing machines.
Also, please appreciate the unit, the factory opened only in June, and July we were still struggling. So July, the execution was still muted. Only from August and September we've been able to come back to normal. So I think from that perspective, the numbers are healthy.
Understood. Just wanted to confirm.
Growth has been 15%.
Got it. Thanks.
Thank you. The next question is from the line of Naval Seth from Emkay Global. Please go ahead.
Good evening, Mr. Lal.
Hi, Naval.
Sir, I have two questions on TV. First, if you can give some insights that new customers, what you have won in the quarter, the volume numbers, what you stated, 0.8, 0.9 million. So, what would be that percentage of their current sales right now, if any insight there?
So, Naval, 100% of the business will come with it.
Okay. Second question is a bit long-term on TV segment. So we are expanding capacity almost now twice in a year with strong order book. So are we on the same path of lighting where from 30% market share we can reach 40-45% for domestic sales? Is that the visibility you have over the period of next 3 years?
So we are striving towards that. You see, the Indian market is around 15-16 million. Now, if we are able to do around 4 million in a couple of years, that's a large number. That will be almost, it will be a large number, almost 30%, 27, 28% of Indian requirement.
Naval, to answer your question, that is definitely achievable with this new client addition and strong order book from our existing customers. So this year also we'll do a decent increase in our volumes as the same period last year. And so with the new client additions, the numbers that you're talking about are definitely achievable by next year or maybe a year after.
So now in this fiscal itself, we will have, I think, 30% growth over last fiscal.
Yes. Sure. Great, sir. Thank you and all the best.
Thank you, Naval.
Thank you. The next question is from the line of Nirav Vasa from Anand Rathi. Please go ahead.
Hello, sir, and thank you very much for the opportunity. Sir, would it be possible for you to give me the breakup of capex that we intend to do in FY21 and FY22, and if possible, breakup of that category, category-wise?
Yes, so Nirav, as part of the PLI, we have to do a capex of 50 crores every year for the next 4 years. So that mobile PLI would be 50 crores every year. So that is one. Secondly, in this year, we have on our fully automatic, the total capex should be somewhere around 65 to 70 odd crores, out of which we have already done a capex of 18 to 20 odd crores. So so balance 40, 45 crores will happen in the balance 6 to 9 months. 6 odd months. And then we will have in other verticals, the average run rate of capex should be somewhere around anywhere between 10 to 20 odd crores. So that specific plans we will have only later. But these would be the broad numbers.
get your point. So my second question pertains again to the
Also, I would like to share here that a substantial investment in our mobile side, we have now secured a long-term payment plan from the equipment supplier. So the payment plan is of 18 months. So the capex will be made, but the cash outgo would be less.
So you'll be paying it as and when the factory is getting operational. Am I right?
No, it's not linked to that, but there is a payment plan.
There's a deferred payment plan, Nirav. Yeah. The cash outgo would be significantly lower than the 50 crore that I mentioned to you.
Get your point. So my other question is again specifically pertaining to PLI. Sir, because of the capex commitments which are there, and other players who have got PLI scheme approvals, especially the Indian manufacturers, their balance sheets are not very strong. So is there any provision in this PLI agreement that we can get some rate, I can say, funding from banks or any of the players? Have they approached you or any kind of a potential JV or something like that because you have got the size and scale, all the customers are empaneled with you, so that it can be mutually beneficial partnership for you as well as the other players?
So on the first question of yours, there is a provision in the PLI scheme, and the government will be sharing the data with us on quarterly or I think bi-quarterly basis, wherein they're going to be, so if some of the other companies are not able to meet the ceiling, then the overflow will be shared with the performing company.
Mm-hmm.
So that's a significant positive. On your point number 2, I'm not in a position to comment.
Yeah, but your observation is right there that there are a couple of advantages that Dixon enjoys. One, our balance sheet is much stronger as compared to some of the other players who have got the approvals for PLI. And of course, we don't have our own brand. So that also makes a lot of difference.
Exactly, because this business is all about size and scale, and their balance sheets are heavily constrained right now. So, thank you very much, sir.
Thank you, Rita.
Thank you. Ladies and gentlemen, due to time constraint, we will take that as the last question. I would now like to hand the conference over to the management for closing comments.
So thanks very much, Ambit. Thanks for this call, and thanks to all the stakeholders for supporting Dixon's journey. We are on the path that we feel that it's on an extreme positive. We feel that industry is having a significant tailwind, and we're going to work harder to deliver more and better. So thanks for your support at all times. Thank you so much.
Yeah. Thank you, everybody. In case you guys have any follow-up questions, you can always call me. Thank you. Thank you very much.
Thank you. Ladies and gentlemen, on behalf of Ambit Capital, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.